Balance sheet, manufacturing concern. So here we introduce what is balance sheet of a company of a manufacturing concern. We will also see what are the elements of a balance sheet. So a balance sheet, let us first see what exactly is that for a manufacturing concern. So a balance sheet is defined as the statement of assets, liabilities and capital according to the formula capital plus liabilities is equal to asset. Capital is owner's funds, liabilities are outsider's fund, and asset is whatever the company has, which will be used to generate income. So depending upon the entity whose balance sheet is drawn, it takes a unique form and format and differs in its makeup for the different entities whose financial position is reported. Hence, for entities like a manufacturing concern, there is a certain form and format followed, where liabilities and capital are tallied on one side and assets are tallied on the other. So you see here, liabilities are tallied on one side, assets are tallied on the other. So liabilities here, what they actually do is, it will be liabilities and capital, which will be on one side, and assets will be on the other side. So total of liabilities in such an arrangement, which would include liabilities and capital, would always equal to total of assets. So total of liabilities will be total of assets. So to recap, liabilities are sources of fund which the business mobilizes from owners and outsiders with the sole purpose of acquiring assets. Liabilities may be short term and long term. Assets, on the other hand, are tools with the help of which income in a business is earned. Some assets stays with the business for a long time, whereas some assets may be of short term. So these are the elements of a balance sheet, which is liabilities and assets. Liabilities includes capital and liability, and assets are basically whatever the firm has which would generate income. Now let us ponder in some detail what liabilities and assets make up the balance sheet of an entity like a small or medium manufacturing concern. So that is where we actually try to see what are the elements of the balance sheet and what all components it has when a financial statement is reported of a manufacturing concern. So first we'll take a look at what is liabilities. So the first one is owned funds, which has proprietor's capital or paid up share capital. It has reserves in different forms. It also has long-term or deferred liabilities. No, long-term and or deferred liabilities is another section of liabilities. So first is owned funds, then it is long-term or deferred liabilities, then it is current liabilities or short-term liabilities, then it is contingent liabilities, and that is where the liabilities are almost listed for a manufacturing concern. And the next section will be assets. We will explain about it when we get to that section. So the first one is owned funds. In owned funds, there is proprietor's capital or paid up share capital. We'll see what that is. So this comprises of equity shares, preference shares, or global depository receipts, which normally the owners, proprietors, and promoters of a business bring as shareholders of the concern. The capital in this case of a company may be issued capital, which is the extent up to which it is intended to be raised, authorized capital, which is extent up to which it is raised, subscribed capital is the extent to which it is subscribed, and paid up capital, which is extent to which it is actually called and received against subscription. So that makes up proprietor's capital or paid up capital share. Next we will see what is reserves. Free reserves is one type of reserve, share premium reserve is another, revaluation reserve and depreciation reserve. So what are free reserves? Free reserves are reserves created out of profit and not kept for certain purposes. Capitalization of free reserves are done by debiting reserves and crediting capital by way of bonus shares. So this happens in the share allocation process of a company. Free reserves. Next reserve is share premium reserve. What is it? So a share premium reserve maybe it depends upon amount of premium collected. What is premium? It is amount collected for shares minus face value of shares. So that difference is the premium. So in share premium reserve, it depends upon the amount of premium collected when raising capital where dividends are not payable. So capital is raised from owners, amount is collected. The difference from the face value of the share is the premium which is collected from the owners and where no dividends are payable. So that is basically share premium reserve. Revaluation reserve, what is it? This is when the firm revises book value of its asset to reflect market value. The asset at a higher value is shown on the liability side as revaluation reserve. So this revaluation reserve is when firm revises book value of its asset to reflect market value. When it hits the market after an IPO, when it hits the market, this share prices may go up. So the firm actually revises book value of its assets to reflect market value, and the asset at a higher value is shown on the liability side as revaluation reserve. And lastly, it is depreciation reserve in this section, which is a type of reserve. What exactly is it? It is the amount of depreciation charged to profit and loss account and is credited to depreciation reserve. So this happens in the case of fixed assets where the lifetime of the fixed asset is defined. There will be depreciation on the life of the fixed asset. Every year a certain amount is reduced from the actual value of the fixed asset. So that reserve is actually the amount of depreciation charged to profit and loss account per year and is credited to depreciation reserve. It is also not to be reported as part of owned funds and it is done by setting off against fixed assets. So general reserve, which is part of profit retained in the business, is according to a policy. So this completes reserves and basically completes owned funds as liabilities. Next is long-term or deferred liability. Debentures or fixed deposit is a liability. Now, how is it a liability? If the balance sheet is drawn for a bank and if the bank is accepting fixed deposit, it is a liability to the bank because the fixed deposits have to be given back with interest. So that becomes a liability. Even for other concerns, if there is a debenture which a manufacturing concern has called, which actually means it is a debt security. So basically the money, whatever the public puts in, has to be paid back, and then it is a liability to the manufacturing concern. So that is debentures or fixed deposits, which is one type of long-term or deferred liability. Next is term loans raised from banks. So loans also the same story, which is basically an asset for the bank, but it is since assets and it's actually an asset for the bank, but here we are talking about manufacturing concern. So term loan raised from banks, this has to be repaid, so it's a burden on the manufacturing concern, so it is a liability. Loans from friends and relatives, money has to be paid back, it's a liability. Next is current liabilities or short-term liabilities, which are short-term borrowings, unsecured loans, deposits, sundry trade creditors, expenses payable, interest, installment or of deferred payment credits, statutory liabilities, and miscellaneous current liabilities. We'll explain some of them actually. So current liabilities or short-term liabilities. Short-term borrowings is one type, where it is borrowing from bank or in form of cash credit against stocks or book debts, bill discounted, bills purchased, foreign bills, overdraft, pre-shipment credit, etc. So these are all short-term borrowings, which also is money to be paid back, so it is a liability. Unsecured loan, which includes commercial paper which is repayable in an year, that is also a liability. Deposits from public maturing in an year, which is again a liability of what type? It is current liability or short-term liability. Deposits which are to be paid within an year. So that is why it is a short term. That's a short term. So that is a short-term liability. Sundry trade creditors, which is bills payable for raw materials, consumables, stores, spares, etc. All short term. So sundry trade creditors, it is also a liability. Expenses payable, which is again a liability. It is of short term, so it is a short term liability which is in the form of wages, salaries, or the rent which is to be payable to the owner of the space which the manufacturing concern has rented out. So that's also an expense. It comes under expenses payable, and it's also a liability. Interest is a liability. Installment of deferred payment credits is a liability, etc. So these are the different liabilities under short-term liabilities. Next is contingent liability. So that is also a type of liability. What is it? These liabilities are not shown in the body of the balance sheet, but are shown in the footnotes. These are off balance sheet items because their possibility of becoming a funded liability depends upon fulfillment or non-fulfillment of certain condition. So that is why it is a contingent liability, the occurrence of which is not certain. Some of the examples are pending lawsuit. We don't know what is the outcome. So it is a contingent liability. Guarantees given by organization on behalf of others, which is also a contingent liability. Taxes and duties under dispute with government, which is also a contingent liability. Another example may be claims against concerns not acknowledging debt. So that is also a contingent liability. So these are some of the examples of the contingent liability. So that covers liabilities which are grouped together in balance sheet on one side. Next we'll see assets which are shown in the balance sheet of a manufacturing concern. So what all different types of assets are shown in balance sheet? Fixed asset is shown, current asset is shown, non-current asset is shown, and intangible asset is shown. So what is fixed asset? So these are permanent in nature and are not disposed of in a short period of time frame. So by depreciation, a small portion of the fixed asset is written off every year, and there is a useful life period until when a fixed asset could be put to use. So examples of fixed assets may be land and building, plant and machinery, vehicles, capital work in progress, furniture and fixtures, etc. So that is fixed asset, which is again a asset which we actually are trying to see. This is listed in balance sheet for a manufacturing concern. Current assets, what are they? That is the next type of asset. So these are held in possession for a maximum period of 12 months and are subsequently converted into cash during that period. So some of the examples of current asset are cash and bank balances, receivables. What type of receivables? Bills receivables. Book debts. If you have given loans or short term, if you have borrowers in the firm, so that money, whatever you give, it is in book debts, which is an asset because you will get back the money. Debtors, sundry debtors, etc. Installment of deferred receivables, raw material components, finished goods in transit, prepaid expenses, stock in process or semi-finished goods. Finished goods in transit, which is an asset actually, because if you sell it, you actually, once it reaches the sales point of sale, or once it reaches the seller, you will get the money. So these are all some of the examples of current assets. Non-current asset or miscellaneous asset. So neither current nor fixed. They are unrelated to business operations and are acquired as a result of compulsion. Example may be investment in non-marketable securities, long-term investments, etc. So these are non-current assets. And lastly, it is intangible assets. Those assets have no physical presence. Those which cannot be touched, etc. are intangible assets. Examples are trademark, goodwill, copyright, patent, etc. So this covers assets which falls in 4 categories: fixed assets, current assets, non-current assets, and intangible assets. So these assets also make up one group in the balance sheet. Liabilities on one side and asset on the other side. Liabilities contain capital as well as liability. Assets will be the forms where the manufacturing concern makes income out of the assets. So those are listed on the other side. So these are basically liabilities and assets. We have given a lot of examples for that also. Next is recasting. What is recasting? We'll recast a balance sheet for analysis purposes, and we'll recast a balance sheet for ratio analysis. That is where we actually see where the concern is headed towards, where the company is headed towards, where the manufacturing concern is headed towards after seeing the balance sheet made on a certain day. So that is where when we recast a balance sheet for analysis purposes. So what we do there? So sometimes we recast a balance sheet for analytical purpose so that we can properly deduce conclusions after seeing a balance sheet. So they are to be grouped in a meaningful way, which may be in subgroups of long-term liabilities, short-term current liabilities, etc. So most of the assets are regrouped in 4 categories, which I have already told: fixed assets, current assets, non-current assets, and intangible asset. Now, recasting a balance sheet for ratio analysis. What happens there? We know ratio analysis, those are a lot of equations based on parameters or factors. So for applying ratio analysis, sometimes they get grouped also in a similar manner. So we are going to see a table or portions of the table where what we do is we take components from trial balance on one side and we will see what its relation is to the items which are on the balance sheet on the other column. So we try to link trial balance elements to balance sheet elements, and we'll see what exactly those are in the table. This is made for recasting of a balance sheet for ratio analysis, for grouping of trial balance items into balance sheet items or factors, so that we can find out a lot of ratios. And based upon these ratios, we will analyze a balance sheet. So this is translation of trial balance item to balance sheet. So in this, current assets, if you note in the first table, the balance sheet item is current assets. So what are current assets? In the trial balance, if there is stores and spares, prepaid expenses, sundry debtors outstanding less than 1 year, bills receivables, stock in process, cash and bank balance, and finished goods. So all these trial balance items actually are related or linked to balance sheet item, which is current asset. Similarly, for current liability, so what all trial balance items are current liability in balance sheet? It may be provision for taxation, bank overdrafts, installment of term loans payable in 1 year, bills payable provision for dividend, bank's cash credit limit, and sundry creditors. So these items, this much items are on the trial balance sheet, and that on the trial balance, and those are linked to current liability in the balance sheet. Likewise, for fixed assets on balance sheet, what are fixed assets? Furniture and fixtures are fixed assets, land and buildings, plant and machinery. So those are fixed assets. What are intangible assets which are in balance sheet? So what are those intangible assets which is in balance sheet in trial balance? So in trial balance, those are preliminary and pre-operative expenses, goodwill, profit and loss account, debit balance. So these are all intangible assets. Likewise, in the balance sheet, when we say long-term liabilities, in trial balance, it may be debentures, unsecured loans after 1 year, and term loan. Also in balance sheet, when we say long-term sources, it may be paid up capital in trial balance. When we say net working capital in balance sheet, it may be raw material. When we say net worth in balance sheet, it may be reserves and surplus. Also non-current assets in balance sheet. In trial balance, it is investment in subsidiaries, debtors outstanding more than 1 year, investment in shares. So investment in, those are self-explanatory. So we can actually see that in trial balance, if there is debtors outstanding more than 1 year, that becomes non-current asset in balance sheet. So this completes a session on balance sheet of a manufacturing concern. How we do ratio analysis will be dealt in a separate session. Thanks.